Well, g'day, Scutty here, ahead of this really important June non-farm payrolls reports a little bit later in the session. And relative to other payrolls reports, which we always know are really important for financial markets and create a lot of volatility, this one looms as particularly important in my opinion. And this quick webinar, I'll go through the details as to why I think it's a little bit more important than what we've seen in the ones earlier this year. Have a look at what's expected. Have a look where rates markets are priced at this point in time, which we know is really influential on FX and equity markets on occasions. And then we'll have a look at some of the technical factors to go and look at across the DXY, US equity futures, along with another couple of FX pairs as well, including the Aussie dollar US cross, which looks pretty good right now. Look, without anything to do, let's get straight into it. And I'm going to explain to you why I think this report is particularly important. And it comes back to what we've been seeing in the data flow over the past few months, because for a long period of time, it was almost universal that we had seen lots and lots of strength coming through in US economic data. It was almost universal in its nature. And that's shown here in this particular slide. Now, this is Citi's US Economic Surprise Index. Those of you who've seen my videos on X and other platforms would recognize this. Now, this is basically an aggregate measure of what the US economic data has been printing relative to market expectations. And I've just circled that big one there you can see. And that is a period about 15 months where almost universally net US economic data was surprising to the upside. Yes, there were downside surprises on occasion, but in aggregate terms, it was almost always beating. But look what's happened over the past couple of months or so. You can see there's been a really stark divergence and a big deterioration. And you're seeing that data surprises are now really negative and growing increasingly in number. So that's really interesting in itself, because what we've seen is also a real recalibration of expectations amongst the analyst community, because there was clear evidence that the growth momentum in the first quarter of the year wasn't as strong as what people expected. And so we're seeing the data missing to the downside on lowered expectations. So it's pretty clear that the US economy is not only slowing down, but potentially rolling over pretty rapidly right now, which is really important when it comes to this payrolls report. Because when you think about what it means for the Fed and when it comes to what it will do with interest rates later on this year, rather than being both inflation and the labor market, with that disinflationary trend that we're seeing right now and the evidence that's accumulating when it comes to activity, it's really only now the US jobs market which is standing in the way between the Fed and rate cuts. That's what I'm seeing right now, because we're seeing that disinflationary trend impact. We know that Jerome Powell earlier this week was talking about that being in place. So the fact that he's laid that on the table means that jobs and jobs alone is really important right now. Just really quickly to go and reinforce what's going on in the US economy. The Atlanta Fed GDP now forecast, we know that it's not a forecasting model, but it's an estimate. And it's just basically showing that right now, relative to what we're seeing just a couple of months ago, economic growth in the June quarter is not expected to be a 4% seasonally adjusted annualized rate. It's now down to 1.5%. And look at the trend that we've been seeing as data has been coming in. The economy is definitely showing signs of slowing down, and potentially far quicker than many people expected. It's also worthwhile pointing out as well, this measure overstated growth in the March quarter by quite some distance. Doesn't mean it's going to become a trend, but it's something to go and consider. Well, without further ado, let's see what's expected. Straight to what we're looking at right here. Now, you can't escape right now that the markets almost always will go and react initially to the payrolls figure. Now, if you look back over time, when the past year in particular, on 11 of 12 occasions, the US dollar has moved in the same direction as the miss or beat relative to expectations. So almost always the dollar moves, whether it's a miss or a beat, whichever direction it is. There's only one occasion where it's not been that case. On this occasion, markets are looking for an increase in payrolls of 190,000, down from 272,000. Now, this figure, if we're seeing historic trends is in place, would actually be revised lower. On 75% of occasions in the past 12 months, we're seeing the monthly figures revised down the following month. So keep a close eye on that as well. Now, payrolls, really important, but what it means for the Fed, it's not the signal that it's looking for. It wants to go and see how tight the labor market is, and that will have ramifications when it comes to wage pressures. So the Fed we'll be looking at what's going on primarily in the unemployment rate. It's expected to go and hold at 4% on this occasion, unchanged from what we saw back in May. Other thing to keep a close eye on is average hourly earnings. We know that the Fed is very, very vigilant to what's going on, particularly with services and prices, and they are very, very influenced by what goes on with earnings at this point in time. So keep a close eye on that. It's expected to go and print at 0.3% month on month. That's down from 0.4% in May. What we saw back, and we see that come through, and in actuality, that we're going to see the annual rate go and dip to 3.9%. Still pretty brisk based off recent historic normals, but it would actually go be the lowest level we've seen in a couple of years. So keep a close eye on that. When it comes to what the most bullish scenario is for the FX market, it's pretty simple out there right now. So bullish for the US dollar would be unemployment holding at this level or declining, seeing payrolls beat and average hourly earnings beat to the top side. That would be undeniably really, really bullish when it comes to the US dollar. The exact opposite outcome obviously would be in case we saw payrolls go and miss expectations, unemployment go and push up to say 4.1 or higher, and average hourly earnings coming in at 0.2. That would be detrimental for the dollar. It really would go and bring forward the focus. Markets will be fully priced, I imagine, by that stage for the first move in September, with a risk that we might see the Fed go earlier in August. When it comes to the equity markets, a little bit different scenario. What you want to be looking at is for not too hot, not too cold. That's by far the most bullish outcome. You don't want to go and derail the prospects for rate cuts, but at the same time, you don't want to go and get concerns out there that demand is about to go and fall off a cliff, because we know that earnings are a very, very important part of the equation when it comes to equity market performance. If you get a tail outcome, you get really, really weak, that could go and be detrimental to the equity market, because it would go and raise those concerns about what we're seeing out there in demand. But if you get a really, really hot outcome, so say payrolls topping expectations, unemployment declining, average hourly earnings coming in above 0.3%, that will go and raise question marks again about the Fed's ability to go and cut rates this year, and could potentially create some headwinds, particularly for cyclical areas of the market. Now, just to go and get some background, despite the deterioration that we've seen in economic data in the States over the past couple of months, there's not been a dramatic shift whatsoever when it comes to pricing, whether it comes to the extreme front end of the curve, the Fed funds rate futures, or say US 2-year Treasury note yields. You can see here, this is just looking at what's been going on in the 2024 Fed funds curve. Now, this is going back to the start of the year, and it's got around about 37 basis points. When you look at how that flows through to rate cut expectations from the market from the Fed this year, it's now favoring 2 cuts rather than 1, but it's not a slam dunk outcome. There's still some debate out there whether we might go and see 2, we may only go and see 1. But there's been no meaningful shift in that potential range since the middle of April, which is really interesting. So again, it comes back to the jobs market. Given we're seeing disinflationary forces emerge again in the US, if we see the jobs market start to go and roll over, the barriers for the Fed to go and start easing policy will come down pretty quickly. And you imagine that the markets will go and move to go and price in the risk of not only 2 cuts this year, but potentially 3. It's not there at this point, but we'll see what happens. It's quite a similar story when you look at what's going on with US 2-year yields. Let's go and adjust the scale here. Now, they're off the highs that we saw earlier this year, but not by any meaningful degree, it's got to be said. No, briefly above 5%. But you look back here, and even now it's sitting above the bottom of its recent range, and not really been any big movement. And that kind of, again, defies that expectation we're seeing when it comes to what the Fed may do. Now, it's only a hunch. I suspect it probably is no impact of what's going on with the US presidential race and concerns about the Democratic nominee, in particular Joe Biden, and what it might mean for Donald Trump and his re-election chances, and to see what potentially that will go and flow through to policy making. We know that Trump is definitely campaigning to go and cut taxes and remove a lot of barriers, which would generally be pretty market friendly and would likely go and also potentially assist higher inflation and higher economic growth. So I think that might explain what we're seeing at the moment. But again, as we saw the start of this year and back in periods late last year when the Fed pivoted, just look how far US 2-year yields went in decline on that occasion, back down towards the low 4% regions. That was when it was well and truly above 5%. So when we see the Fed pivot and pivot dovishly, I expect to go and see this are going to have quite a dramatic downside reaction, like we saw back last year, and it would override what we're seeing when it comes to the Trump trade 2.0. Now, with that in mind, I want to go and just have a look at quick some of the charts out there at the moment, which we know are really, really important from a technical perspective, not just a fundamental. I want to kick off with the DXY daily, US dollar index daily. Now, it's not a readily traded market, granted, but it's something to go and pay really close attention to, because right now, whether you're talking about a daily time frame or you're talking about a weekly time frame, the signals are really, really pointing to the potential that we might go and see some meaningful downside in the US dollar. You can see here on the daily chart, I might just go and zoom in a little bit here. Now sitting and actually through the 50-day moving average, just a simple moving average. It's done a lot of work around this level for a long period of time going back over the course of this year and into 2023. So it's a level that's often respected. If we see this level break cleanly, you can see here, this low around about 105.05 that was printed a couple of sessions ago on the back of this payrolls report. There's nothing to suggest that we might see a move back down towards 104, where it did some work back at the start of June. The 200-day moving average is just below, but relative to the 50-day moving average, it's not really paid as much attention, in my opinion. And you can just see here, the price action has been almost universally bearish, and that reflects what's going on when it comes to the deterioration in some of that US economic data. What I want to do is just go and quickly have a look at what's going on in the DXY weekly, because it's also giving me a signal that potentially we might go and see some downside risk forming. You can see here, downtrend dating back to the latter parts of 2022, and just constantly rejected on the weekly time frame. Back here, and again here. But you can see on this occasion, just the pattern. Bullish bar, doji, big bearish bar, and actually sitting at the lows for the week so far, but it's not complete yet. We need to go and see what happens post payrolls and at the end of the week. But right now, that looks like an even star pattern. And again, if that comes to fruition, a lot of traders out there, technical traders, will be looking at that and likely thinking, okay, that points to more downside. You can see at 104, the price did a lot of work over the course of recent months. That would be the first downside target to keep a close eye on. Momentum indicators are also starting to point to mounting downside risk. You can see RSI has broken its uptrend, and MACD is also about to go and cross over from above. Two signals that I like to go and look at when it comes to momentum shifts and directional risks. Excuse me while the screen flickers here. We'll be back in 2 seconds. There we go. We'll have a quick look here. I might have a look at the Aussie dollar, because it looks really peachy on the charts, and I know that a few of you are undoubtedly here in Australia watching on. You can see here, not really a downtrend, but it's a trend line that had been in place. And you can see it had been constantly rejected. Tried to go through on multiple occasions over the past month or so, but failed. But then just look at this big bullish bar we're seeing this week. Big breakout, momentum all in the favor of the bulls right now. And above that 67.142, which was the high that was hit back in May of this year. Really bullish breakout. It will take a pretty strong payrolls report, and I'm talking about payrolls exceeding expectations, unemployment holding or going backwards, and average hourly earnings either staying at 0.3% or increasing back to what we saw 0.4% in the prior month. It's looking really good on that weekly time frame. I might go and zoom in again on the Aussie just to go and bring it back a little bit at this point in time. I know that some of you out there don't like to have the really longer time frames. Again, you can see here through that 67 zone, lots of probes above that over the course of the last month or so. Unsuccessful, but on this occasion, we had some luck. And 67.30 is an interesting level. It's kind of acting as a bit of a support and resistance back that we saw in late last year. And you can see a bit of a retest, and then we've gone and had this another launch higher again. So further above that, 67.75 is a topside target. At this point in time, I imagine that if we did see, unless it was a really, really strong jobs report, that we might go and see some support kicking in around about 67 for the Aussie. Going back, 67.75 is a minor level to go and look at, but more importantly for me is the high that we saw back in December this year, last year I should say, at around about 68.70. Above that as well, the double top, 68.93, that was struck in June of last year. That looms as a far greater test if we go and see this bullish breakout go and extend a little bit further. When I have a look at dollar yen, we know we've got record speculative shorts amongst the trading community as I mentioned in the SFT COT report. And you can see here, look, it's been in a really strong uptrend, lots of multiple uptrends at the moment, and none of those have really been under threat. But just looking at the moment, no, looks like it may be rolling over. I'm just going to zoom in to go and get in because it's got a long way to go down if it starts to get that direction. But you can see here, around about 160.07 is a level where it's gone and held recently. That's gone also bounced today. So that's the first level to keep an eye on. You can see here back where the intervention took place a couple of months ago, 160.23. That's the other target on the downside. Above, we need to update this chart, about 161.95 or so is the current high. That will be the first level of resistance to go and keep an eye on. You can see here, look, the price action has been pretty bearish, but that probably reflects that we're seeing some position adjustment taking place because we know that the market is very, very short at this point of time. On the downside, look, 160.23 would be difficult to go crack. It would have to go and take a really, really weak report. But if that was to go, I imagine it'll be a pretty swift move back down towards this intersection we're seeing here, 158.25, and this uptrend that dates back over the course of almost a year. Cable. Dollar pound, you can see here, getting a lot of attention given the British election result, which had been priced in a long time ago, it should be said. But I found this, looking at it on the charts today, it's sitting in a really, really interesting zone. You can see here, around about 128 has just been like poison for this pair over the past year or so. Every time it's tried to go above it, it's either failed or the times that it has broken above, it's been rejected. So 128 is a really key level. And you also have this downtrend that's been in place for well and truly over a year as well. And you can see two again, we've had one close above, two failures, and again, it's just squeezing up against that right now. Minor support at 127.40 is the first level to go and look at. But if we see a break of this zone here, particularly this 128.94, you'd imagine that a lot of traders will be looking for a move back to potentially 1.3 or even higher at this point in time. So the momentum, like the Aussie dollar, is all to the upside right now. MACD is crossed over from below, and we also have RSI in an uptrend at this point in time. Just to go and kick off, I want to have a quick look at what's going on with the equity markets, particularly US equity futures. Now, not much to go and garner from this other than it's been completely bullish outside of the Dow for the main bourses. Let's have a quick look to go and kick off with that Dow futures chart. And you can see here, it's been sitting in a triangle for a little bit, calling up. I thought we might go and see a bullish topside break at some point last week, but didn't materialize. And if I zoom in here, the price action since has been kind of iffy, not really giving any strong signals whatsoever. On the downside, you can see 139.193 is a very minor support level at this point in time. Lots of dojis, but really inconsistent price action. And look, that probably reflects that we don't have any really main information coming up until this report tonight. So we'll see what happens. They could potentially go and see a bullish break. It's pretty clear this downtrend is being respected at this point in time. 1, 2 rejections, got close a couple of weeks ago, and then failed pretty miserably. If we see a break of here, I'll be looking for a retest of the record highs, 40,358 in Dow E-minis at this point in time. It's a little bit more clear cut when it comes to what's going on in SPOOs, E-mini futures. Let's wait for that to go and click over. Yeah, uptrend, uptrends, uptrends. It's been bullish momentum, and really it's been difficult to do anything other than go and buy dips. Now, remember what I said about the various outcomes. It would take something to be either a really, really cold report or a really, really hot report to go and kind of quash the bullish momentum we're seeing at the moment. Indeed, we saw when US markets closed for the Memorial Day, the July 4th holiday, you can see here closing at fresh record highs and actually sitting above that level right now. If you just 5591.25, not really gone anywhere over the holiday period, understandable. But when you look at what's going on with momentum at this point in time, all to the upside, big uptrend in RSI and also MACD, not really giving any signal at this point in time. When it comes to the downside, 5510.25 is where it did a lot of work over the course of the past week and a bit. Also, there's a gap that I'm keeping a close eye on here from about 5466 down to 5454. That's an area that may be targeted, which would also be kind of corresponding with the bottom of the current range. Beyond that, again, it would take a really, really horrible report to likely going to see any further downside. And we know that the 50-day moving average has been really influential on price, really well respected for a long period of time. It's continued to go and trend higher at this point in time. If we're going to see any breaks, potentially lower, look, 5, 3, 6, 8, 25, given the proximity of that 50-day moving average and how well it's respected, will probably be where it'll be scooped up, you would imagine. Nasdaq's even more definitive in what it's suggesting right now. Strong uptrend, just beautiful bottoming pattern, then breaking through the previous record highs and holding there ahead of this key event. One thing I'm keeping it closer though is we're seeing divergence between RSI and price. Prices hit new highs, divergence is moving lower. So that's one warning sign. But I'll be honest, I've been saying that about the Nasdaq since the beginning of the year. We've had that in place for long periods of time. Yes, we're seeing brief pullbacks, but it's only been really modest in scale. So it's something to keep an eye on. It's something that's a minor warning, but something to just go and keep a note of. Or I'm not going to go and base my trading decision based off what's going there. You can see pretty definitive on the chart, 19,730 is where the price bottomed a couple of weeks ago. That's your first level of support. Also a gap as well, down to 19,618, which may be targeted. But realistically, again, the 50-day moving average, you can see here, a support level around about just 19,000 or so. That's where I'd imagine, given this uptrend is in place as well, is where it would be scooped up. Through a bit, hopefully it goes and gives you some insight as to what to go and expect tonight. But again, it's really, really important. Always a volatile event, but to me, this one is going to be really key. If we see clear signs that the activity rolling over in other areas of the economy is now filtering through to the labour market, it really will go and put the impetus on the Fed and put some pressure on it to go and start easing rates. We know that at this point in time, it thinks that policy is still incredibly restrictive at these levels. And if it thinks that and it sees the economy is rolling over and it's pretty confident that disinflationary forces are back, there's nothing to go and prevent near-term rate cuts from the Fed. Anyway, we'll see what happens later in the session. Best of luck with your trading. Thanks for joining me.